We had taken up 3 transactions to analyze the accounting, the identification of the accounts or legs involved, number 1. Number 2, classifying the accounts. Number 3, applying the rules. And number 4, deciding the debit or credit accordingly. We had taken the case of introduction of capital into business, purchase of furniture, opening up a bank account. We'll take up 2 more and try to analyze how a transaction is to be split up. How do you identify the 2 concepts, classify them, apply the rules and decide the debit and credit. Take another example. It is example number 4. Purchased goods from Stocks Limited. I'm just taking an example. For rupees 60,000. This is a business transaction. It is a purchase of goods, stock or inventory, inputs. The stocks purchased goods from Stocks Limited for rupees 60,000. Now, first of all, when a transaction is worded this way, purchased goods from stocks, naturally the first question that arises is it a cash transaction or a credit transaction? When the name of the supplier is given, without mentioning whether cash or check is paid, it means it is a credit transaction. I repeat, where the name is mentioned in a credit purchase or credit sale, without specifying that cash or check is paid for the same, it is a credit transaction. Suppose I word this transaction a little differently. Purchased goods from Stocks Limited for rupees 60,000, paying cash for the same. Then the name is not relevant. It is a cash transaction. In other words, unless specifically given that cash is paid or received or a check is given or received, we take it as a credit transaction. So the purchase of goods from Stocks Limited for rupees 60,000 in the absence of other information is a credit transaction. It is a credit purchase. Identify the 2 legs. Purchases is one. Purchases account. It is an expenditure. A purchase account is a nominal account because it represents an expenditure. Expenditure and incomes are the ambit of a nominal account. So purchases is nominal. It is a nominal account. The other party involved here is Stocks Limited. Stocks Limited in the name of a party is a personal account. So purchases account, Stocks Limited account. Purchases account is a nominal account. Stocks Limited account, being in the name of a person, is a personal account. The rule for a nominal account is to debit expenses and losses. So purchases is debited. And the Stocks Limited account by default will be credited. But still, let us test for the rule. The rule for a personal account is credit the giver of benefit. Here, Stocks Limited is giving us the benefit. Stocks Limited is a giver, so it is to be credited. So in a credit purchase of goods, we can thumb rule it. Purchases account is debited and the creditor is credited. A person who supplies goods on credit is called a creditor, to which the business becomes a debtor. A credit sale of goods to a person, subject to payment on a deferred basis on a future date, makes the buyer a debtor, where the business becomes a creditor. So a creditor has a debtor and the vice versa. So the purchase of goods from Stocks Limited for rupees 60,000 is, we decided, a credit transaction. The two legs, purchases account, Stocks Limited account. This is nominal and therefore debited. This is personal. Applying the rule, the giver of the benefit is credited. So Stocks Limited is credited in this case. Let's take another example. This time let me take up a sale transaction as the fifth one. After analyzing the commencement of a business with capital, cash provided, after analyzing opening a bank account, purchasing furniture as an asset, credit purchase of goods that we have seen now. Let us take another transaction, the fifth one. Sold goods on credit to Sam for rupees 1,25,000. Sold goods on credit to Sam. Monetary impact of the transaction is 1,25,000. Here it is given anyway, on credit. So there is no room for a controversy here. It is a credit sale transaction. Goods are sold, so there is a sales account. It is on credit, so the other is a person, Sam's account. Sales account and Sam's account. So the sales account being nominal, it represents an income or a revenue inflow. Sam's account is a personal account. A nominal account is debited if it is an income, if it is an expense, and it is credited if it is an income. So here sales account is an income. It has to be credited. The benefit of the transaction is given to Sam. Debit the receiver of benefit. Sam is debited. So this is how a transaction is to be analyzed into the two legs or the two accounts, classified into the respective accounts, where the rules of the classification are applied, and based on which the debit and credit is analyzed. So for every transaction, at least one debit and at least one credit are to be identified or spotted to book or record the transaction. So let's make a summary of the transactions that we covered so far. Starting from the beginning, commencement of capital with cash, opening a bank account, a credit purchase, a credit sale. Now, had this been a cash sale, obviously instead of Sam, we would have debited the cash account. If a check is received, you would have debited the bank account because my banker receives the payment. So for each of the transactions that we have covered so far, we try to analyze. I'm just making up a table, a columnar table of the debit and credit. In the first case, where capital was introduced, a capital of rupees 2 lakhs was introduced. We debited cash account and we credited capital account. Ram's capital account. In the second transaction, a deposit into the bank. We had debited the bank account and credited cash account. Debit and credit for every transaction. I'm just summarizing what we've done so far. The next was purchase of furniture, an asset, something which is not meant for resale in the ordinary course of business, something which is used in carrying out the business. It is not the object of the business, it is the instrument of the business. Furniture being an asset was debited. So debit was to furniture account. We are analyzing the debits and credits. The debit had gone to the furniture account and the credit was cash account. It was paid in cash. Cash was paid for, or it was purchased by check. So it was the bank account which was credited. When a check is issued or given, it is natural that the bank will pay it. There's a principle of a check as a banking instrument. The next was a credit purchase, goods purchased from Stocks Limited, worth 60,000. The debit had gone to purchases account and the credit had gone to Stocks Limited account. Then we had seen the case of a credit sale transaction. In a credit sale, the debtor is to be debited. The debtor was Sam. Sam's account was debited, being the receiver, and it's a personal account. And the other is the sales account. Right? So here was a real account, a personal account, a personal account, a real account, real account, real account, both are real accounts here. Personal account, sorry, the bank account is a personal account. Purchases, nominal, Stocks Limited, personal. Nominal account, personal account. Personal account, nominal account. So this is the method by which it is done. Once this is done, the first record comes in. The first record or accounting record or bookkeeping record called the journal. The process of recording a transaction in the primary books, identifying the debit and credit, is called journalization. The process is called journalization. Or the entries, the transactions are put into a journal. So we need to understand the format or the framework of a journal after analyzing the debit and credit for each transaction. A journal is the primary book of accounts, the primary record which will incorporate these debits and credits. After you have identified them, applied the rules. So journalization is the first step after identifying. We have not yet accounted for the transactions, remember. We have only identified the legs of the transaction. Identified them, classified them and analyzed, which is to be debited and credited. Once you analyze it, the accounting starts. So we now come to the format by which a journal is prepared. A journal is typically the first book of account. A journal is formatted in a manner in which the date appears first. Put down the date. Put down the particulars next. I would like you to memorize this if possible. After some time it will become a matter of habit. Date, particulars, we have a column called the ledger folio. A reference in the next record of the next book called the ledger. Then we put in the debit amount in the denomination and the credit amount in the currency denomination. This is how a journal looks. So a page is divided into 4 or 5 columns with the date, particulars, ledger folio, rupees. Debit appears first, credit appears next. So after identifying the debit and credit, we pass a journal entry. Passing a journal entry in the journal, technically called journalization. So if I were to adopt the journal, if I were to extend or commence bookkeeping with the 5 transactions that we took as an example, we start with, let us say, it was 2020, April 1st. Ram had commenced business with a cash of 2 lakhs. We decided that cash account is debited. So you mentioned cash account debtor, DR with a dot. 2 lakhs. We will come to this a little later. This is nothing but a reference of the page of the journal entry in which the transaction is accounted for cross verification. Then leave a space, have an internal margin and start with 2 and put the credit account. 2 capital account. Rupees 2 lakhs as the credit leg of the transaction. Credit amounts put in the credit column, debit amounts put in the debit column. So here this is the journal entry for commencement of capital by Ram in our example with a cash of 2 lakhs. Cash account debtor to Ram's capital account, or just capital account because we are doing the bookkeeping in or for Ram. After the 2 debit and credit have been put, mentioned within brackets what we call a narration. It explains the transaction to a common man, starting with the word being. Being, business commenced with cash. So the date, particulars with a debit first and the credit a little away, a bigger margin. Putting the word debtor, it's a prefix, it's a short form, it's an acronym. Debtor, cash account debtor 2 lakhs, to capital account 2 lakhs in the credit column. Being, business commenced with cash or cash introduced into business. That is the first journal entry. Then preferably leave a line and come to the next transaction. For lack of space here, I have to remove this and go on to the next one. So coming to the journalization of the second transaction, I'm just removing the aspects relating to this and retaining the form or the format. Let us say that is on 2nd of April. On the 2nd of April, we have opened a bank account with SBI, Federal Bank, Union Bank of India, Canara Bank, some bank. So the journal entry there is bank account debtor. The debit was to go to bank account and the credit to cash account. And the amount deposited was 1 lakh. Open the bank account, depositing cash there. I go fill up my application form, complete all the KYC detailing, get a passbook, get a checkbook if necessary, collect all the internet banking details, facilities available. Maybe I spend an hour in the bank giving all my identification details, address details, all those things. I've deposited 1 lakh in cash by the pay-in slip. My bank account starts. So bank account debtor to cash account, what do I mention as a detail? Being opened or opening of, opened a bank account with so and so bank. So the common man will understand, okay, this is why this entry was passed. This was debited, this was credited. So bank account debtor to cash account. This is the form in which the journal entry is written. So the debit and credit are put in appropriate places in the book. So after opening the business with capital, next we open a bank account. So leaving a line between the two journal entries, this comes next. So the date, the particulars, ledger folio will come up to it later, debit and credit amount. Let's take the third. What was the third transaction and how had we identified the debit and credit? The third was the purchase of furniture. Ram's business, or Ram had purchased some furniture for which the payment was made by a check. So the entry is furniture, and let us say that is the 3rd of April. 3rd, furniture account debtor to bank account, because the payment was made by check and the amount was 40,000. I insist that you punctuate the amounts pretty well. 2,000, 2, 1,000, 18,000, 18, 1,000, 1,80,000, 1, 80, 1,000. Be very neat. The secret of success in accounts is discipline. Be disciplined and everything falls in place by itself. So here 40,000 debited, 40,000 credited. So the narration to be mentioned here being furniture purchased and check issued. Furniture account is debited because it comes in, an asset is coming in. Bank account is credited because the banker will pay when the check is presented by my vendor. So this is the journal entry, the journalization process for purchase of furniture, which was our next transaction. Coming to the next, it is purchase. After opening a bank account and purchasing furniture, Mr. Ram, our businessman in this case, is purchasing goods. He is making his first purchase of raw material, which will be converted into finished goods for sale. So the third transaction was purchased goods from Stocks Limited for rupees 60,000. So here it was purchases. Let us say it is the April 3rd. Purchases account debtor to Stocks Limited account, and the amount was 60,000. We mentioned in brackets there the narration for it. It's called a narration. Being credit purchase of goods. Purchases account debtor 60,000 to stocks limited account 60,000. So with the date we have summarized that transaction. The next is sale transaction. So how do you do that? Leaving a gap after the purchase account. So you have 1 plus 2 lines consumed by this transaction. The sale transaction that we took in our example was also on credit. The question itself, the problem itself specified that it is a credit sale transaction. So you have a SAM account which is debit. Let us say this is on April 5th. SAM account debtor, and the amount was 1,25,000. To sales account. Sales account is credited because it's an income. SAM's account is debited because he is the receiver of the benefit. Sales account 1,25,000. And the appropriate narration being credit sales to SAM. So with that, this journal entries come. So we keep passing these journal entries one after the other, leaving a gap of about 1 or 2 lines and being as neat and disciplined about it as possible. So with that we wind up with this session. We'll continue in our next session where I introduce compound journal entries. Thank you.